Imagine this. The stock market crashes, and millions of people lose everything: jobs, savings, and homes. It happened in 2008, and it could happen again. Did you know that, in the US alone, more than 2 million people lost their jobs during the 2008 financial crisis? The market fell nearly 57% from its peak to the bottom. For many, it was too late to prepare. But here's the thing. Warren Buffett didn't just survive the crash, he thrived. In fact, he made billions while others were panicking. How did he do it? It's not magic, it's strategy. Buffett knows what to do before the crash hits, and today, we're going to share his secrets with you. In this video, we'll uncover Buffett's time-tested strategies to build a portfolio that can survive market crashes. We'll talk about how to spot the warning signs before it's too late. And we'll show you why having cash on hand could be the most important decision you ever make. Stay tuned, because these are the strategies that could change the way you think about investing forever. Chapter 1. Buffett's Secret Blueprint. How to build a fortress portfolio. Warren Buffett's secret to surviving market crashes starts with building a resilient portfolio. The key is selecting businesses that can stand the test of time. Buffett often says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This speaks to the importance of quality. But what exactly does that mean for investors? It's about finding companies with strong competitive advantages, a proven track record, and solid leadership. Buffett's portfolio is filled with these types of businesses: Coca-Cola, Apple, and American Express. These companies don't just ride market trends, they thrive over decades. What makes them so durable? Their ability to maintain strong earnings even during recessions. For example, Coca-Cola has been in Buffett's portfolio for over 30 years, demonstrating a remarkable ability to weather downturns. To build your own fortress portfolio, start by focusing on economic moats. These are advantages that protect a company from competitors. Think of Apple's brand power or Costco's membership model. Buffett believes these moats are critical for long-term growth. Research shows that companies with strong moats tend to outperform the market by an average of 5–7% annually. Next, don't chase trends. Buffett advises investing in what you understand. If you don't fully grasp a business model, don't invest. By focusing on companies you know and trust, you reduce the risk of being caught off guard when markets fall. Finally, don't forget to diversify. Buffett suggests holding a mix of stocks across different industries. This can help cushion the impact of market crashes. But remember, diversification isn't about owning hundreds of stocks, it's about owning the right ones. Chapter 2. The Calm Before the Storm. Recognizing market signal. Buffett is famous for saying, "The stock market is filled with individuals who know the price of everything, but the value of nothing." This insight speaks to the dangers of following market hype. Rather than trying to predict the next big crash, Buffett focuses on identifying early signs of economic weakness. One of the most telling signals is the yield curve, which has a historical track record of predicting recessions. When short-term interest rates exceed long-term rates, it often signals an economic slowdown. This has preceded nearly every US recession since the 1970s. In fact, the yield curve inverted before the last 5 recessions. Watching this signal can give you a heads-up to prepare for market turbulence. Another important signal is when stocks are overvalued. Buffett famously advises, "Be fearful when others are greedy, and greedy when others are fearful." High price-to-earnings (P/E) ratios often indicate that stocks are overpriced. For example, during the dot-com bubble in the late 1990s, the P/E ratio of the market hit a stratospheric 44, far above the historical average of 15. This was a clear warning sign of an impending crash. To prepare before a crash, Buffett stresses the importance of monitoring economic indicators, such as corporate debt levels and consumer confidence. When debt levels rise, businesses are more vulnerable to shocks. Similarly, if consumer confidence drops, it often means that spending will decrease, which hurts corporate earnings. By tracking these indicators, you can better prepare for downturns before they hit. Chapter 3. Cash is king. Warren's greatest secret to surviving crashes. When a market crash hits, it's easy to panic. But Buffett's greatest weapon in these situations isn't selling stocks, it's cash. Buffett has always been a strong advocate of holding large cash reserves, allowing him to take advantage of opportunities when others are running scared. During the 2008 financial crisis, Buffett's Berkshire Hathaway famously invested billions in companies like Goldman Sachs and General Electric, when their stock prices were beaten down. This wasn't luck. Buffett had the cash ready to deploy when the time was right. In fact, he said, the most important quality for an investor is temperament, not intellect. This calm, patient approach is only possible when you have enough cash to wait out market chaos. Holding cash doesn't mean sitting on it forever. Buffett doesn't want piles of cash just sitting idle. But in times of crisis, having cash gives him flexibility. He's able to buy quality companies at a steep discount when panic sets in. During the 2008 crisis, his $5 billion investment in Goldman Sachs earned a 10% return per year. That's the power of holding cash. Studies show that companies with strong cash positions are more likely to survive market crashes. For example, during the 2008 crash, companies with higher levels of cash were able to avoid massive layoffs and bankruptcy. This kind of stability is crucial when the market is in turmoil. Moreover, holding cash allows you to stay focused on long-term opportunities instead of reacting to short-term volatility. While others panic, you can calmly assess the market and make strategic buys. This mindset is at the heart of Buffett's approach to investing. Chapter 4. The Margin of Safety. The shield that protects your investments. Buffett is a big believer in the margin of safety, a principle that helps protect investments during downturns. This concept means buying stocks at a price lower than their intrinsic value. If you buy a company for $50 per share, but it's worth $70, you have a cushion in case things go wrong. The margin of safety allows investors to sleep easy during market crashes. If the market drops 10% and you've bought wisely, your losses will be much smaller. Buffett uses this principle to ensure he doesn't overpay for stocks. In fact, when asked about his strategy for success, he said, "We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful." By sticking to the margin of safety, you're buying quality at a discount. This not only reduces risk but can lead to huge rewards when the market rebounds. When you pay a fair price for a great company, you set yourself up for long-term gains, even during market crashes. Chapter 5. The Power of Patience. How to stay calm when everyone else panics. One of Buffett's most powerful strategies is patience. While many investors sell their stocks at the first sign of trouble, Buffett waits for the right opportunities. He has said, the stock market is a device for transferring money from the impatient to the patient. When everyone else is panicking, Buffett remains calm and focused on the long term. Patience isn't just about waiting. It's about being confident in your investment decisions. When you've built a portfolio of quality companies with strong fundamentals, you don't need to react to every market dip. You can afford to wait for the market to recover and even buy more when prices are low. Studies show that long-term investors outperform those who react to short-term market changes. In fact, over the last 30 years, the average annual return of the S&P 500 has been around 10%. But that return is significantly higher for those who hold their investments for the long haul. Chapter 6. Buffett's Playbook. How to snatch opportunities when others run while others panic. Buffett seizes opportunities. During market crashes, stocks of high-quality companies often get sold off simply because fear takes over. But Buffett knows that this is the best time to buy. In 2008, when others were dumping their stocks, Buffett invested $5 billion in Goldman Sachs at a 10% return rate. This kind of deal is only possible when you're prepared. Buffett's strategy is simple. Be ready with cash, and when others are scared, buy valuable companies at a discount. This is how he's been able to outperform the market for decades. When everyone is fleeing the market, you can be the one buying shares in companies that will bounce back. The key to Buffett's success isn't just picking the right companies, it's having the right mindset. He's never in a rush, and he knows that the best opportunities often come during times of crisis. If you found these strategies helpful, don't forget to like, subscribe, and hit the notification bell for more insider tips on value investing. With the right knowledge and mindset, you can turn market crashes into opportunities for long-term wealth. Keep learning, stay patient, and remember, investing isn't just about timing the market, it's about preparing for it.